Thank you for sticking it out. One short word before we go to the discussion of the discussions. Folks, if you want to just settle down, we can do this. What I didn't do earlier was introduce our facilitators and our last moderator. So I'm remiss in that. Moderating the panel before this was Mary Murphy from the Pew, who is project director for the Pew Trust State Fiscal Health Initiative, and a great friend and a great ally. And you will always find her doing outreach to state and local leaders. We'll all be at the NCSL Legislative Fiscal Directors Conference before the NCSL big event coming up. And before joining Pew, she was a researcher and analyst at Wider Opportunities for Women, specialized in social safety net programs at Urban, and has a bachelor's degree in sociology from Reed College, which is no small matter. Two of my kids went to Bard, which is the Reed of the East, and Reed is the Bard of the West. So it's a tough school with great output. Thad Calabrese, who is in the audience somewhere, hanging out. Thad just did a podcast with us earlier, so I'm going to go through the bios because I didn't pull these out. Thad is an associate professor at NYU Wagner, estimable public administration school in New York. He studies public and nonprofit financial management, is the co-author of a new study that the Citizens Budget Commission of New York put out on building a rainy day fund for New York City, which for various legal and accounting reasons doesn't have one. And you will find him active in the Association for Budgeting and Financial Management. If any of you are not a member of that, you should be. That's the Budget Professors Organization, and probably the best subgroup of ASPA. And he's on the GASB, the Governmental Accounting Standards Advisory Council, and has co-authored 3 textbooks, which is a damn sight more than I have. And that will get us to Lisa Washburn, who is with MMA, Municipal Market Analytics, our partner in our research efforts, and she's a managing director. She lives in the next town to me in New Jersey, is a consistent critic of New Jersey's wonderful fiscal and financial practices, much to the delight of public officials. She is the watchdog, and she is the industry practices co-chair for the National Federation of Municipal Analysts, and can also be counted on to write incisive critical commentary, and also is a former managing director at Moody's, I might say, which gets us to our last discussion, which is going to be a discussion. It's a discussion of discussions of our little workshop sessions on rainy day funds, which I think has actually probably accomplished something. Kil Ha is going to lead it. Kil is Mary's colleague at the Pew. He's president of Pew's. Not vice president. Okay, Pew does. It's late in the day. I missed the vice part of it. I'm sorry. So Kil does something at Pew's governance portfolio. And he was director of policy consulting at the Fannie Mae Foundation. Went to Cornell and NYU and Columbia, which is no small matter. Is a good friend, and also Kil and Mary are a tag team and great allies to have. So we're going to discuss the results of this session. We've taken pictures of the notes, and hopefully we could distribute that. It augments the rainy day fund working paper, and take it away, Kil, and then we'll wrap it up and send you all home.
Hi, everyone. I have the unenviable task of being last on the agenda. But the good news is that the live streaming is off, so we could be a little bit more candid. And I've been told that I have a face for radio, so, you know, it's also good news on my part. But let me also just acknowledge that Rich and Katherine were also moderators or facilitators for the last session. And as you know, they've been consultants for Pew for over a decade. They've been columnists for Government Magazine. They've worked for the National League of Cities. They are strategic consultants to the Volcker Alliance, and just two amazingly curious and terrific people who I've gotten to know over the years. And I always look forward to seeing them. So I just wanted to acknowledge that they were also part of the facilitation group. My task is really to sort of flip the tables and to try to engage all of you in a conversation about rainy day funds. I liked how Bill put it. It's a discussion of discussions. It's very meta. I'm hoping that it won't be too abstract and we can actually sort of talk about some concrete things that we've talked about from, you know, what's the right way of thinking about the size? Is it on an annual basis through the deposit mechanisms, or is it just looking at total fund balance? What are the right ways to incentivize deposits, as well as thinking about how much you want to put aside? What's the best way to think about withdrawals and the timing of such? And then on the flip side, when do you want to pay the rainy day fund back? So these are some basic questions, but at least as I found in the conversation we were having, it's very complicated. There are maybe no real good answers for the questions that we pose to all of you all, but we're still going to give it our best shot. We've got 30 minutes to do this before we tackle our next great sort of challenge, which is hitting the bar. So with that in mind, I thought I'd just open it up to see if people had any general comments that they wanted to share from their last sessions, any sort of major themes that emerged, or any questions that you're still sort of struggling with, because I think that that's important to sort of surface as well, too. So can I get a volunteer?
I'll go.
Yes.
So in general, thank you. In general, we discussed the fact that a rainy day fund is part of an overall policy response that includes looking at, making cuts as well as trying to find new revenue, obviously very difficult in a downturn. And so the rainy day fund shouldn't be looked at as the only option and just to spend it down as soon as possible, and then you have a lot more challenges to go. So it's part of an overall policy response and not the only policy response. Anyone wanted to?
Okay, we'll go here first. Sorry.
Maybe just adding to your comment, you were part of our group, and that is one thing we talked about, the fact that there are sort of hidden rainy day funds in state government. In effect, special revenue funds, which may have excess funds and so forth, which can be utilized in times of real financial stress. But the fact is they're probably not very transparent, and therefore probably there's an understatement of the real reserves that a state may have to deal with a financial downturn, and maybe greater visibility and transparency about that would be a benefit to the states as they make their case to the rating agencies and so forth, that they may have additional reserves which may not have the same status as the rainy day fund, which is quite visible, but those funds do exist in many cases that can be utilized during economic stressful periods.
Two more things that we talked about. One, and this was kind of Merle's point, that in this report we looked at statutes, but it's not just statutes, it's also culture. And the culture of states and what they're doing and what they've done historically is really important to look at. And also, another thing that came up is the gentleman here from Site Selection, how important this is to companies. And again, not just the rainy day funds, but the whole fiscal policy, how important that is to companies as to where they want to locate.
Bill or Lisa?
we had a number of the same issues about it being part of a balanced approach, right? So making sure that you weren't just spending down your rainy day fund, but you were utilizing budget cuts and revenue raising as well. One of the challenges with rainy day funds that we talked about was that there's no constituency for them. So it's hard to get buy-in to do that when there are other needs that are out there. And then one of the more important points was really defining what it is for your state to have a rainy day. What does that mean to you? And then that can help to drive how you spend your money.
Sheila? I see that she has the mic.
Yeah, we talked about the size and whether you should have a certain size or put money, have a target of how much money you should put in. Our bottom line was you should think about it, and it depends. But planning was, the most important, and so that was our group's. On a personal level, I just think that the discussion of highlighting rainy day funds is kind of like me highlighting that I have a savings account without looking at my credit card debt, and that you need to, California, yes, they have theoretically a rainy day fund, but they have $200 billion of debt. So do you really have a rainy day fund? And I think highlighting it gives elected officials and citizens, I've read in California where people are like, hey, well, you have extra money, you should either give it back to the taxpayers or you should expand programs. So I think it gives a false sense of security and makes people make policy decisions that are not based upon knowledgeable information because they're not looking at the holistic approach.
Bill?
So some of the things we discussed, number one is that a rainy day fund is as much a political statement as it is a financial statement. A rainy day fund can't cover everything, especially in a severe recession. And as Sheila points out, there are other debts and other reserves that needed to be attended to. So it's not symbolic. It in many states it has uses for immediate relief during disasters, as North Carolina did last year. But so it's not a be all or end all. We discussed the formulas for rainy day funds and whether they should take into account both the length and depth of historical recessions in setting a target, how much your revenue drops over time, which led us into a discussion of investors and rainy day funds, and maybe some of the other investors in the room want to comment on this. That rating agencies are sensitive to trends more than immediate balances. Virginia got dinged. We dinged Virginia, as did the rating agencies a couple years ago, for drawing down the rainy day fund during a period of economic growth. It was not something that was typical, and so people are sensitive to that, but they're not. The rating agencies are less sensitive to a single year's number than they are to a trend, and that in this current environment of low interest rates and intense demand for municipal securities, not a lot of attention, the investor attention gets paid to the level of rainy day funds. There are other things on people's minds.
Does anyone else have any opening comments? Lisa? Right here.
Just quickly, it occurred to me that another interesting point was raised at our table by Mark Funkhauser, publisher of Governing. And the point he made, which I think is a really critical one, is that it's not just that rainy day funds are used to pay the bills in hard times, but also to allow a state or a municipality to have some time to think about what it should really be doing. It buys you that extra little bit of time so that you don't immediately say, we're in deep, deep trouble, across the board cuts without any kind of prioritization or thought to that process.
Yeah.
to that point, we talked about long-term planning, right, and some of the stress testing that Utah is doing. And in doing that, they can get a better sense, or a government could get a better sense of how they might approach a downturn. So if it, you model what's going to happen, what would we go to first if we had a 30% drop in revenues? Where would we first tap? And then how would we utilize the rainy day fund? So we talked about that. Also, we struggled with allowing more flexibility to access the rainy day fund, or less flexibility for accessing the rainy day fund. And I think that one of the themes was, if you have more flexibility, you should have more rigid replenishment rules so that you're sure that the money will come back in. And then another point that came up was, when does something transition from being a rainy day fund event to being something that's ongoing? So should there be budgeted amounts for hurricanes in hurricane-prone states that doesn't utilize the rainy day fund, it's only over a certain amount? So when do you have events that you've experienced multiple times, and now you have to make them a budget item versus a tap on the rainy day fund?
Great. So I'm going to transition a little bit and use moderator's prerogative to ask you a question, which is, a lot has been discussed about the targets, fund balances. As Rich and Katherine mentioned, there was this arbitrary figure of 5% of expenditures for a long period of time that sort of served as the standard. Now that standard is evolving as we apply more risk-based sort of analysis to thinking about what's an appropriate level of savings, and that's very state-specific. Is this still a worthwhile sort of road to go down? Should we be thinking about targets in such a sort of explicit way? Is there an opportunity cost to doing this? Are we sort of, as Sheila sort of noted, focusing on one thing, to the detriment of ignoring like ongoing sort of liabilities?
So two things. I do think it's worthwhile. I think whatever the right benchmark is, I think states, I think 5% was probably very early on in the process, and I think people are around the 10 to 15% now. But I don't know what, having a model I think is a good idea. I think it's also important, we talked a little bit about this, that, and Gabriel mentioned this earlier, that states that rely, particularly states that rely on income, capital gains tax, they tend to get a spike at the end of the economic cycle before that drop-off. So in addition, I think those policies, and you outlined some of these in your paper, that sort of try to cap that spike and set some of it aside so it doesn't get into its budget or is equally as important.
Mm-hmm.
I mean, of course we should be choosing numbers and having targets. I know in Ohio we have a situation where we've hit the statutory cap, and a lot of people keep saying the budget stabilization fund, the rainy day fund, is full. That's the phrase people use. It's full. It's full. Well, at 83.3%, which is what the statutory cap is, that wouldn't necessarily cover what would be needed to address a shortfall during a moderate recession. And if people don't know what the numbers are under any sort of risk analysis, they're going to see the statutory limit and say that's full. And that's not necessarily because they're malicious. It's just because they don't have the information. So that risk analysis and those actual numbers need to be brought to bear, because policymakers a lot of times don't know the reality of what is needed during a recession.
I guess one thing that sort of came out of our discussion, I think, was this is a sort of a more specification of what Sheila was saying. It depends sort of means that, like, maybe not every state would have the same target. States have different sort of revenue structures and different expenditure needs during recessions, et cetera. But that doesn't mean that states shouldn't have any targets. They can have state-specific targets and then stick to those. It's just that a 5% rule for every state seems kind of arbitrary and not the way to think about it, probably.
I mean, I think the revenue volatility definitely has to come into the equation, and then, you know, bring up pensions again. You have to look at your out-year budgets and the gaps, even in these great times, and what that looks like in order to try to come up with a number that's a little bit more individualistic to the challenges that any state is facing.
I have a question for Kill.
Oh, hold on one second.
Okay.
Yeah, go ahead.
I have a question for you.
Sure.
Pew did, I thought, a really lovely infographic showing the 50 states and how many days worth of operating expenses the rainy day funds could take them through. And I don't remember Illinois, it was who I was referring to earlier. I think you said it was 20 minutes, but there was a wide range. Could you talk a little about that? I thought that was one of the more interesting pieces of work done because it gave you a different way of comparing states one to the next as to how prepared they were, because it told you, you know, if you can only last a week, it's not going to do you much good. If it can last you 6 months, maybe better. Kill?
Yeah, I mean, what we did was essentially just made that statistic a little bit more accessible for the general public, just to let them know how many days you could operate, sort of tapping into your rainy day fund if you should, like, if money should stop coming in. An implausible scenario, but just to sort of drive home a point. And again, I think that one of the things that, you know, we tried to do is couch that analysis in the context of broader sort of fiscal measures that we were also looking at, because we were trying to paint a more holistic picture of like what the states were doing when it came to responsible financial management. But it is, you know, from our perspective, just a useful way of making that sort of rainy day funds and savings a little bit more accessible to a general audience, and that was primarily the point. But thank you for mentioning that, Rich.
To go back to the point with the other long-term liabilities, I think that's a really important issue, and it gets lost in the rainy day conversation quite frequently. And then to link it with the caps, when we were writing about a proposed one for New York City, we actually we actually were putting forth a rules-based deposit requirement with a cap, and that if the cap was ever attained, which frankly I would be shocked if that ever happened, but if the cap were attained like in Ohio, that the deposits were still made so that the fiscal discipline was there, but they were made to the OPEB trust or to the underfunded pension system, so that the discipline of tamping down new spending was there, and that you were basically funding prior spending, for lack of a better term.
Mm-hmm. No, that's really smart. Sheila, I'm going
Yeah,
to give you the last word.
perfect closing comment of, you know, people in the past have always asked me, like, well, you're talking about these bad budgeting practices, and, you know, what is this really going to mean to me, and what's going to happen, and da-da-da-da-da. Illinois, it's happening, okay? So I'll give you two specific examples. A few years ago, the vendor who provided ammunition for the police academy said, the state is not paying me. They're like 180 days, 300 days late in paying me. We are no longer going to give you that ammunition. And then the state could not easily find another vendor to provide them that. And they were just able to pay a premium to a vendor in Indiana to get the ammunition. The last example I'll give you, and I have many if you want to hear them, are horror stories, is if you're a state employee or a retiree and you're on the state health care plan, when you go to your doctor, they will expect you to pay cash up front for your immediate, for your office visits and also for your elective surgeries. So like knee replacements. You have to pay cash up front, and then when the state reimburses the doctor, they will reimburse you. So this isn't just a numbers game. This bad budgeting practices is adversely affecting people throughout the state, and it's going to happen to other states also if it continues.
Great. Well, on that note, and I'm kind of sorry to end on that note, but obviously if you want to feel better about your state, you should talk to Sheila and learn more about Illinois. I want to just conclude the panel. I want to thank all of you for being wonderful participants, so please give yourself a round of applause. And I also want to thank the Volcker Alliance for hosting us today and the Atlanta Fed. This was truly a very special day. I learned a lot. It's good to connect with people who are like-minded and curious and interested about fiscal issues. So thank you very much.
All right, we're going to go home shortly. So thank you. Number one, thank you to the Atlanta Fed again and again and again. Chris and Dave and Raphael and everybody and the entire staff for just putting on a splendid show. You were just great. Thank you to all of you folks who flew in here and stuck it out. I hope you've learned something, and we'll take it back. Remember the Rainy Day Fund working paper. It's on. You have in your packages, and it's online. Spread it around. If you need hard copies, let any of us know. Truth and Integrity in State Budgeting is out there. You can review the entire conference on our website once it's cut up and archived and put up at volckeralliance.org. Watch for us in the coming weeks making presentations and discussions and whatnot. We have an ASPA webinar on infrastructure coming up in about a week. I'll be at the Brookings Muni Finance Conference along with some people from Pew and whatnot. We'll be at NASAC and ABFM later in the summer, and we'll see you at the next Volcker Alliance conference. Thank you so much, and have a wonderful trip home.